Good morning, ladies and gentlemen. Well, the wrist dial 71, not bad. All week we have been basically trending slightly better, but as you can see from here, we are just bunching these moving averages. The difference between them is coming lower. So we need either a thrust higher or a thrust lower, which basically tells me that we are arriving at very, very important timing. From a timing standpoint, we are arriving at a very important juncture, and that, we will have quite different prices in a few months' time. I don't think this is going to happen next week because of the Fed. I think it's going to take a while longer for certain trends to be exhausted, and I will go into them now in detail so you understand what my longer term thinking is. All week, the yield curve in the US and in Europe has been flattening. It's been quite an amazing move. If you have a look, really, we started around 140 level and we finished at the 130 level in twos tens. It is quite likely that we test this 126 level and we actually break it over the next couple of weeks and quite possibly come all the way down to something like 110, 115 level, maybe something like that, this kind of area. A very nice ABC kind of move, but it's absolutely certain that the yield curve is flattening in all tenures and wants to continue to flatten. The way the bonds behaved last week was very impressive indeed, and I will go into detail of that slightly later. But let's have a look at what the other tenures did. Here we have all of them, 5s, 10s, 5s, 30s, everything is flattening. So 5s, 10s, we've gone through the resistance at 73, 74. We are now going somewhere around here, say 59, 60 basis points in 5s, 10s. 5s, 30s, we are at the very crucial 140 level. Would not surprise me in the slightest to see 124. These are pretty large moves in the yield curve, and you can see that we are basically matching this period here back in 2015 almost exactly. To me, what is important is that this relationship, when this is 10s, 30s, is just not moving at all. That to me indicates that the inflation expectations are muted and that people are giving the benefit of the doubt to the Fed that this is transitory. If people really thought this was not transitory, 10s, 30s would be much higher, much wider than it is. But the fact that we are still in this range gives me, pause to think that the Fed is actually right and the market is actually beginning to agree with the Fed. All of last week, 5-year forward inflation expectations, which you can find on Fred, have been coming down. You can see that we basically started at 232 and we ended up at 221, which almost matches how much the 5-year rallied. While we are still in this range that we have been since the beginning of the year, which is basically, call it 205, all the way up to 238, and we start coming down, that is going to give the benefit of the doubt to the Fed. I think we need a new high in inflation expectations to have any worries and to even start thinking that the yield curve can steepen. while the situation is as it is, and you have rates, short-term rates as low as they are, and you have as much liquidity out there as there is, it is very expensive to keep on steepeners. And the market will hate to do it, and will only do it when it has to, i.e. when it has bad news and it has fear. At all other times, the tendency of the yield curve will be to flatten. And while that is the case, it is almost impossible for outright yields to go much higher. And we'll examine those now. Here we have the 5-year note. 2s and 5s are basically more or less stuck. We can enlarge this and we can see what happened. So basically the 5-year note has broken the 79 level and it is slowly coming down. Could it come down to fill this gap down to 62, 63? Absolutely. I think that is the tendency. You can see how it's all rolling over. But we have the 200-day moving average coming in to support those levels around the 62, 63 area. I think that is the path of least resistance. If we have a look at the 10s, this is 10s and 30s are more interesting. If we enlarge this, we will see that basically we have the possibility of an ABC which takes us down in the 0.382 retracement of the whole move, which is going to be somewhere around here, which is around 122 to 129 basis points. So that is almost another 20 basis points lower in the 10s, and that indicates really the type of flattening that we are having. If we have a look at the same thing in the 30s and in the TLT, we can see that basically we can have easily moved down to 2 from 215 where we closed, 2 to just below 2 in the 30s, and that gives us in TLT, if I enlarge this chart for you, you can see that we could quite easily get up to these kind of levels around the 145 to 146 area, matching more or less what we had here back in just before the crisis, the coronavirus crisis. I don't see it much better than this, 146, 147 maximum, and then we start coming back down. Basically forming a huge head and shoulders, which at some stage we will see if we can break down. But for the time being, I think the trend is certainly for lower, longer term rates, as I told you, unless we have bad news, imminent and immediate bad news. The tendency will be for the yield curve to flatten, for the longer tenures to rally, 2s and 5s doing the least, flattening, ergo flattening the curve, and that gives a bit of a boost to the out of favor growth stocks that we have seen over the course of the past few months. Exactly the same behavior is obvious in Europe, and there is definitely a reach for yield in Europe as well. This is the bubble, the equivalent of the 5s. We are exactly where we were when the coronavirus struck. We are, absolutely spot on around minus 65 basis points. I doubt very much that we can do much better than minus 68. In fact, this is the flattening tendency is going to stop this in the next 2 or 3 basis points. But if we turn the chart to 10s, i.e. the Bund, we could now have a move back down to where we were with the coronavirus struck, which was here, which is around the minus 38 level without any problems. So the same kind of flattening tendency as we see in the US. It's pretty obvious, really, that Europe is in the same situation. If we have a look at a chart of 10-year Italy, you can see how much we have come off in the past week or 2 weeks since we achieved those targets. You know, what a great trade that was. And now we could easily come all the way back down to, 55 basis points. It's a reach for yield. And that is obvious if you look at here, which is the chart of the Bund against the BTP. As I told you last week, if we go through these kind of levels, we are going back down to these lows around 90 basis points. And that just means that people are reaching for yield. Anything with positive yield, they want it more than they want the safety of the Bunds. And France, same thing. As I said, if we go through 15, we are probably going to 0 and probably even to minus 10. So you can see that throughout the European complex, the tendency is to pick up yield wherever you can and take prices, futures prices higher and yields lower. The differential, I'm sorry, that's the wrong chart, this one here. This is the differential between Bunds and the 10-year note. It actually broke the 175 level, not very much, only 2 or 3 basis points, but it's pretty obvious that really we are trying to go down towards these levels around 164, and if we don't stop there, we'll go down quite a bit further. But it just shows you that there's a reach for yield everywhere. People are trying to pick up yield wherever they can, which is the opposite situation that we had, before. We have no more fear that this inflation is not transitory. Inflation expectations are not going higher. And as soon as that happens, the reach for yield starts. I'm positive that it's going to continue for the next couple of weeks, unless the Fed does something really strange. I don't think the Fed is going to do anything strange next week. I think they are very happy with the situation as is, and they will definitely not want to rock this boat because the yields are going exactly where they would like them to be. The dollar is the most frustrating thing ever. Having been in such a tight range, and you can see here in the dailies, I might enlarge this for you, until it busts this support band between 89.41 and 89.80. There is absolutely no reason to sell it, because there will always be these moves back up to 91.01 and this 91.41 level, which I think is very, very important. There is not very much more to be said about the US dollar. Nothing seems to get it into trend. Yield differentials, growth differentials, nothing. The FX market has really gone to sleep, and really, as I said, trying to force lower levels, trying to push your luck at lower levels is really, really silly. If we change that to a chart of Euro USD, you can really see that 119.88 is going to be the equivalent of around just above 91, and that is going to be the really key level. Through there, and we can go substantially lower in Euro USD. I don't see why that would happen. You can see here from the dailies that we are now beginning to just get all the Bollinger Bands are going to start coming in, the moving averages are going to start coming in. So I would have thought at some stage we test this, 119.88, 120.11, depending on the time frame, and that will be the level to actually decide what to do. Until that happens, there really isn't very much to do or even think about in FX. Gold is becoming a bit of a puzzle. My view is that it anticipated everything that there was to anticipate, and now basically is just consolidating and going sideways. I don't think gold, I think longer term gold is going to the center of the asset butterfly between bonds and equities, but I think it's going to take a very long time. I think it is going to basically trade between the low to mid 1700s and 1920, 1950 for a very long time. I don't think we will see levels below 1730 for a very long time either, but I don't think that we start to move higher until the end of the year. If I enlarge these daily levels so you can see them, I think this 1760 level is now absolutely, 1764 is now absolutely key. I think we will, it's closed below 1881, which I don't like. I think the pressure in the early part of next week is going to be down to 1820s, but the 1820s is about as bad as I can see it next week. It is not responding to the lower real yields, and I think the reason again is because this move anticipated the lower real yields, and now we're in a consolidation phase. If I'm correct and we get a continued flattening of the yield curve, gold is really not going to do very much, because it's going to be supported by that. But the fact that it's anticipated so much of the flattening of the yield curve probably means that it's going to go in real terms nowhere over the course of the next couple of weeks. This is the crucial relationship, I believe. This is gold against TLT. And as I told you last week and the week before, we have reached levels which are, resistance in the past, and which are quite a long way away from the moving averages. I've been bullish of gold relative to TLT ever since we broke this level 21.60. And as you can see, apart from a couple of feints lower, it's now substantially higher. It is now very much substantially higher. And this is why I said earlier that basically gold has anticipated all there is to anticipate, and it's now moving back. So as TLT does better, gold does nothing, this line comes back into support. That makes sense to me. If we come down to here, this kind of level, that'll be very good support. And that can happen over the next couple of weeks as gold does basically nothing and TLT does something slightly better. And then we might be in a position to start moving back higher. So that is why I believe gold is really not a buy over the next couple of weeks. Let TLT do its work, let gold do nothing and consolidate, and then it'll be in a position to start moving higher. If we look at the crucial relationship between gold and copper, you can see now it's just, meandering. It is not breaking the 158. I think that would be quite significant. Because that would actually, I think, favor a move higher in TLT. So it's quite possible that we do that, reach around this kind of level, but I don't think it's going to be a very, an expansionary move. I think this is a corrective move. gets to the moving average, comes back down. So that is also telling me that gold is not going to do very much. Bonds are going to do slightly better, and gold is just as a result between say the dollar does a little bit better against the euro and bonds do slightly better as well. As the yield curve flattens, gold is pulled in many directions and basically net does very little. If we have a look at DBC on a weekly chart, you can see that it's continuing to do better. I mean, there's very little to be said. DBC is still on a tear, and unless it starts closing below this 1868 to 1841 area and does some pretty large reversals, all I can say is that it's eventually going to this 2439, and that is that's a big move. That's another, what is it, 25%, something like that. I mean, it's a long way. So there is no doubt that the commodity rally is still alive. That will naturally mitigate how far bonds can rally in terms of lower yields. But for the time being, bonds are not paying attention to commodities, and easily they could go their own separate ways. Equities are frustrating and beautiful at the same time. Beautiful because they respect the levels to the tick. You can see this 42, 32, 60, 33 level. It never closes below it. It just gets there. As soon as it closes above, it touches it, it goes back up. This is basically a market which has beautiful definition, but is also, I think, pretty dangerous in the longer term. This kind of low volatility cannot last much longer, but it can last a while. What is likely to happen, I happen to agree with a lot of people, which slightly worries me. If I go to a daily chart, you can see that the daily Bollinger Bands are respected very well indeed, and those come in the 4260s, 4270s. I think we're likely to get there, but also think that the market is likely to come back from those levels. I think it's obvious that we are very fully valued, and the way that we are getting there is via growth stocks being pushed up by lower bond yields, which in turn depresses XLF, and therefore SPY can only go up the difference between how much more XLK goes up than XLF goes down, which is not very much. That is the situation that we are stuck in. The only thing moving stocks is actually bonds, and the expectations for what the yield curve is going to do. So yes, we're going to do slightly better, but we're not going to do a million miles better. A lower kind of volatility regime. The problem with that is that when we have fully moved in bonds, the only way for stocks will be down. So while lower volatility is going to persist for a while, at some stage is going to pick up. That's pretty obvious. NQ is being supported by the yield curve. I have very little doubt that QQQ is going to break this previous high level. I'll actually put a line in there. This is the previous high close, 342, and go up towards 348. It's as the bonds do better, so the growth stocks do better. 14,044 is the level of NQ. It's pretty obvious that it's going to break through it and start making new highs. It's all a function of bonds. As soon as bonds do better, NQ gets pushed higher. it's going to last until it doesn't. So there's really not very much to think about there. And if we have a look at the spreads in the against the techs, you can see that the move is now lower down into support in XLF, XLK to around 25 again, matching what the bonds are doing. And really the other move is going to be here interesting. I'll enlarge this. When we get there, this is NDX over DJI. When we start getting here to the moving average, that's another % or two to 41 or so. Probably is going to be time to start switching from the Dow to the from the text to the Dow, which indicates that bonds, after they've gone another 10-15 basis points, that's going to be it. So there is really not that much to think about. This is the variable. We get down to here, this kind of level, 25 and a half. That will be the end of the move, XLF, XLK, XLF, and that is why the S&Ps are doing what they're doing. They're respecting every level, but they're not doing much better. So while that continues, we continue to play what is available. The one thing that is undeniable is that the European market is far more interesting than the US. It's outperforming the US finally. And the stocks is doing better than the DAX. What worries me is that we are here at the top of this line, but how important can that be? I still think that we reach at some stage this 4,512 level, which is the on the monthlies where we were in 05, 06. It certainly, I think, Europe is a place to have money. Stocks are relatively cheaper than in the US. And while this reopening theme goes on, I think Europe continues to benefit. You can see on a monthly basis, we keep on going higher. On a weekly basis, we keep on going higher. And we are definitely outperforming other sectors. This is a chart of SPY over FEZ taking out the FX component. And you can see, I will enlarge this area here. You can see that we are at some very close to a very important support at 854. I think that needs to be watched very carefully because through there, and we are going to come down to 805. And that is what I'm looking for. I'm looking for continued outperformance by Europe. I much prefer, if I'm going to be long of anything, and it's going to be stocks rather than S&Ps. And it's actually going to be, if I want to be long of the US, I'm going to be long of NQ. I'm not going to be long of S&Ps. So I think Europe for the next couple of weeks is going to be a better performer still than the US. I've been saying it for quite some time, and I will continue to say it. I think the odds favor Europe over the medium term now. I'm certainly looking for at least 805 on this spread. I also wanted to make you aware of this chart, which is FEZ over EWG. So that is really the stocks, i.e. the whole of Europe as opposed to just Germany. And, without a doubt, we are in a bit of a trend from, we're making new highs for the year. And I think that we are headed towards this kind of level, 144. We're now 138, so you can work out the percentage move. But, it gives me confidence in the view that European shares as a whole are doing better. If Europe as a whole is doing well, FEZ tends to outperform the DAX, and that tells me that this move in Europe has some legs yet. Both the EM and the Nikkei, which seem to be tied at the hip at the moment, are very disappointing. They just don't hold levels and they just move sideways. There is very little impulsion, there's very little interest, it seems, and that is puzzling to an extent. But while EEM does not break the 5208 on a closing basis, on a weekly closing basis, it's just correcting. That's all that can be said. I don't think anything very much interesting happens to it next week. But the one that's building definition is now the Nikkei. And as you can see, basically the high close was 30,205 on the week. And we are basically have been stuck on a closing basis between 30,205 and 28,180, which to me now is a very, very important support. You can see that all the Bollinger Bands on the weeklies are coming into it. I think that whichever way the next move is, it'll come from a close outside of those two levels. Not a lot more to think about, but you can see how long we have spent here. We have spent in this area since the beginning of the year, basically, and it's going to be very interesting which way we go. All year we've been in here between 28,180 and 30,205. I'm watching this for signs that something is turning in equity land in general. I will continue to watch it. Nothing there at the moment, but it's giving me a note of caution about the whole of the equity sector. And finally, the VIX is where it was inevitably headed to, which is 1558. This band of support. It is, how much lower can it get? Can it get down a percentage lower? This is where we were before the coronavirus. Can we be trading in the next few weeks in a band between 1558 and 1197? Yeah, of course we can. But I think the odds are beginning to favor at some stage a move back up towards filling these gaps around 22 and 24. Is it going to be imminent? I don't think so. I think the Fed is actually going to send the market to sleep. So basically next week I really am looking for no more than an 18 print in the VIX. I think it's unlikely to go any higher than that. There is really no reason at the moment to start thinking that we're going to have big moves. And therefore, I think it's more likely than not that we are in a lower volatility regime for a while. Does the while last a few days or a few weeks? I have no idea. I just know that the VIX will certainly be the first one to give you warning signs about a change in direction in equity land. I just don't see it for the next week or so. While the SPX does, as I showed you, respects all the levels as beautifully as it does, there's really no reason to start buying volatility. The first sign of volatility going back up will be when SPX starts breaking some levels, and we have absolutely no sign of that at the moment. And finally, to the summary table, I've reconstructed it so it's logical. You have the US yield curve and you have the individual tenures, and then here you have the Europe, and then you have the equities, and then you have the dollar and gold and commodities. All the levels are marked here. I think the tendency is obviously to flatten, as I said, the same tendency in Europe, and the tendency is for the peripherals to outperform bunds, which basically means that you are looking for a yield grab. People are going and getting yield whenever they can, i.e. in BTPs, in OATs, anything which is trading over bunds. SPX, I mean, all the levels are there. A break of 42.33 is the first sign that you will get on the 195-minute chart that something is going on. Until that happens, I think that NQ is likely to break higher and take SPX up into the 42.60s, 70s. I think that is almost a given. The fact that EEM and Nikkei can't do very much gives me a note of caution, but stocks is exploding, so probably, what's happening is that people are rotating out of EEM and Nikkei into stocks. I think stocks can go still, nearly 10% from where we are. And therefore, while Nikkei is stable and EEM is stable, I'm not really too worried. I will start getting worried for the whole of the complex if Nikkei starts breaking through the 28,180 level on a closing basis on the weekly. When that happens, I begin getting worried for everything, and I look like a hawk for VIX to give me a clue. I don't think it's going to happen next week, but what the hell do I know? I'm just going from level to level. It just doesn't make any sense to me that VIX starts warning next week. I think it's much more likely to happen towards the end of June, sometime into July. But, that's what I'm looking at. Dollar still frustrating. DBC still rising. Gold, I told you, I don't think anything happening. I think 1820 to 1920 is going to be the range for quite some time, because I think probably we need to get this whole move in the yields out of the way before gold can regain some stability and leadership. Still looking at Apple and Amazon because the moves there are really unconvincing, and it just shows you how stretched NQ will be if we get to new highs in NQ without Apple and Amazon being anywhere near new highs. And that will give me a note of warning for what development can possibly happen to NQ, how far it can possibly go, and therefore drag SPX up, unless these two behemoths participate as well. Thank you very much indeed, and tweet you on Monday.